I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. If you want to make friends, I'm just trying to save a little money. My job is not just to entertain, but to put a day like today into context. So call me, 1-800-743-CBC. Tweet me at Jim Cramer. Happy third anniversary of the great bull market of the 2020s. Nothing like a major flare-up in the trade war with China to put an end to the celebration before it even started, though. Dow plunging 879 points, S&P plummeting 2.71%, NASDAQ nosediving 3.56%. It was a real ugly day, and the sell-off probably not done yet. Even with today's beatdown, it's been a huge run over the past 3 years. Tremendous move that's embraced many sectors and led to gigantic gains. You're much more likely to keep those gains, at least if you just take a little something off the table, even up here, because we're way up. Do I think today marks the end of the multi-year rally? No. But I do think we've grown complacent and overly optimistic about President Trump's trade policy ever since the post-Liberation Day bottom in April. Trump's Truth Social posting today shows that the China relationship is not good, with Trump canceling his meeting in 2 weeks with President Xi, and just an hour ago calling him hostile and saying he's now going to impose 100% additional tariffs on Chinese goods. That's almost all the way back to the initial level from Liberation Day, and it is sure to hurt many Chinese businesses. For good measure, by the way, he's adding on export controls on critical software to try to rival Chinese husbanding of critical materials that only they have in scale. It looks like a relationship that the president often called a good one wasn't all that good after all, and it just got a heck of a lot worse. Until today's vicious decline, we were far more focused on how much the Fed will cut rates to help jumpstart the economy. I went down to the Fed yesterday and led a panel of smaller banks. They all said that rates are too high and are stifling business, suffocating growth. It was a very constructive, enjoyable meeting. But one Truth Social post obliterated those good vibrations. I do thank Vice Chair Bowman for the opportunity, though. Now, we bought a little bit of stock, not a lot, for the Charitable Trust today, and we only did so because there could be some of that art of the deal thing going on. Maybe something's resolved over the weekend. Trump was reacting to still one more trouble point, another squeeze on rare earth minerals by President Xi to show the West who's in charge. The timing of that action, so close to the president's peace deal in Gaza, didn't sit well with Trump. Still, I don't expect relations with China will sour to the point where all of today's declines can be justified. We need them, and they need us. And they are, you know what, they're hit a lot harder than we are by these new tariffs. At the same time, I am conscious that we're heading into the seasonally strongest time of the year. I don't want to pass on these instant opportunities for companies that can benefit from rate cuts or from having their stocks rendered cheap because they are in the S&P 500, the big basket that takes down everything, the good, the bad, the ones that are hurt, and the ones that aren't. Which brings me to our game plan for next week. Monday, we'll be coming to you from the San Francisco Bureau as part of my annual pilgrimage to Dreamforce, Salesforce's tech extravaganza. We'll be sitting down with some of the most important people in tech, among others. It's going to be amazing. I expect to get some clarity on the 100% tariffs that the president will slap on China. The ripple from his comments turned into a torrent as the session went on, and I'm guessing he doesn't want to see the stock market coming unglued here. The president likes things big and beautiful, not anemic and ugly. Tuesday, it starts earnings season, like I tell you in How to Make Money in Any Market, available on Amazon. This is the period that defines most stocks, the earnings season. Tuesday's a big day for earnings. Just in the morning, we have 3 stocks we own for the Charitable Trust: BlackRock, Wells Fargo, and Goldman Sachs. All 3 have had a good run for the year, and they aren't exactly in the crosshairs of the trade wars. I think Goldman Sachs is liable to have the biggest upside surprise. I hope Wells Fargo CEO Charlie Scharf says he's willing to buy back more stock if it comes down at these prices. Not to be outdone, J.P. Morgan reports too, and it should be a usual superb quarter. You may wonder why we don't own that one for the Charitable Trust too. Simple. One of the things you're going to learn if you join the club, you can't own them all. You already have 4 financials in a 32 stock portfolio. We get results from Citigroup as well, and I got to tell you, close observers think that bank run by the affable, cerebral Jane Fraser will put up the best numbers of all. Beyond the banks, we hear from Johnson & Johnson, which should have the strongest numbers of any pharmaceutical company. The stock shrugged off a bad loss in one of those talc lawsuits where the plaintiff accused J&J of knowingly selling a product that contained a carcinogen asbestos. I think that the stock didn't go down, but actually went up. That it's a sign that the stocks finally stopped being hostage to these interminable lawsuits. Domino's reports, too. Now, this is interesting. A lot of people think they're going to miss the quarter. We got to hear from more banks on Wednesday, and I've got to tell you, Bank of America tends not to do all that much, but Morgan Stanley has been surprisingly positive for this last several quarters. Ted Pick shooting the lights out over there. We also get results from one of the most reliable healthcare companies, Abbott Labs. We've owned Abbott for the trust for almost ever, and I think it's just terrific. What else? Well, Salesforce holds its analyst meeting on Wednesday at Dreamforce. And this charitable trust holding has been under pressure. It is down an astounding 27% for the year. I think it's because AI eats software, as they say. A twist on software eating all of tech not that long ago. I'll tell you how it is for what's becoming a brutal stock to own when I go out to Dreamforce. There's also, get this, a Dollar Tree meeting, okay? Now, this stock has been under pressure, too, largely because of tariffs. It was barely down today, which seems too positive, given that our president's threatening to put these 100% tariffs from China. I think they will get hurt, and numbers have to come down, and they'll do it at the meeting. Wednesday evening, we get arguably the best possible read on this almost dataless economy when trucking giant J.B. Hunt and United Airlines report. J.B. Hunt tells it like it is. They've been talking about a freight recession for ages. United can tell us the difference between the front of the plane, corporate customers who pay a lot of money, and the back, where regular people do their flying. Thursday morning, Taiwan Semi reports. I usually get up at 2:30 in the morning because that's when they report, for heaven's sake. This manufacturer of chips for both AMD and NVIDIA and many others will give us an overview, and I expect a very rosy picture. Schwab gives us his numbers, too. And why do I want to look at this? Well, I like to look at retail participation in the market. I think more and more people are coming back to stocks, one of the reasons why I wrote my book. And I hope today's meltdown doesn't drive those people right back out. They won't if they read it. After the close, we're going to attempt to learn why CSX fired Joe Hinrich not that long after he was named Railroader of the Year by Railway Age. I don't know the details, but I'll tell you something. It looks like Joe was railroaded. Finally, Friday, what we hear from American Express is this is one of the most reliably unreliable patterns. Amex has a tendency to decline right after reports. Then you have to pounce because a week later it turns out to be going much higher, and you've lost your chance. I don't think it will be any different this time. We also get results from SOB, the old Schlumberger, and I bet this oil service titan tells it like it is. To me, that means oil, which broke through $60 a level, could break down below 60. I think it could go to 55, and that's a distinct possibility. The bottom line, it's a wild week, complicated by precipitous decline in Treasury yields, which normally would signal better times ahead. But after today, it's hard to think of anything positive that can happen, and a lot of negatives that might definitely happen. Let's speak to Mark in Virginia. Mark.
Booyah, Jim. Long time viewer here.
Thank you. What's up?
I've been holding Ford stock for quite a while. It's been a tough week for Ford. I stayed invested even when it climbed rather than taking profits because I believe in the company and appreciate the dividend. Do you think it's still a solid long-term hold, or is it time to reconsider my position?
Okay, I was thrown by the impact that this fire had, and it's caused me to recalibrate. I do think that Ford's good, but I think numbers might be too high because that fire hurt so many parts of their operation. All right, I know today makes it hard to think about anything positive happening next week, but I believe after another little dip, perhaps some money, that we could get some good news. We've got earnings coming up. On Mad Money tonight, if you break up with your girlfriend or wife, it's not great. But if you break a company up, well, it could be one of the greatest things to ever happen to you as an investor. I'm taking a closer look at Honeywell and DuPont and giving you my take on the splits. Then, if you're trying to get a read on Europe, there's no better place than Banco Santander. I'm sitting down with the company's CEO to get a grasp of what's going on. And next week, as I just mentioned, we head out west for Salesforce's Dreamforce conference, and I'm giving you a preview of what we have on deck. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.